Alright, so let me just briefly show you what we're going to be looking at. Okay, so you can see that the market pushes down, starts to push up, and we generate some liquidity. Right, the liquidity gets ran and we start creating higher prices. We then push up, pull back down into the area which was ran, and we see higher prices from there. Again, a very similar situation. Okay, the market pushes down, we hit this support level, we start to run up. We then get a sell through the liquidity. The market then pushes higher and then mitigates from this level, and we see higher prices. So if we move over here, we can see liquidity generation, a run through that liquidity, sell through that liquidity, a push higher, mitigation of that level, and then higher prices. So I push higher, tap down into that level, higher prices, right? On a lower time frame, liquidity generation, a run of that liquidity, right? A breakdown, tap back into that order block, lower prices, okay? A run of that liquidity, or liquidity generation, a run of that liquidity, tap back in, lower prices. Same here, liquidity generation, a run of that liquidity, a move down, a tap into it, move away. Move over here, liquidity generation, a run of that liquidity, tap into it and move away. Okay, on a higher time frame, a run of the liquidity, right, a break above, a tap back into it, and then higher prices. Even down here, run of the liquidity, order block, right, higher prices, okay? Alright, so I hope you're all having a good week so far, whatever stage of your trading journey you're at. This video has been requested from a trader who's struggling to understand the concept of institutional mitigation. So I'm just going to run through that again in this video just to hopefully shine some light on the subject, okay? So just before we continue, I've been asked to change the background of my charts. Obviously, as a lot of you know, watch my videos, I normally have the dark theme, but there's been a couple of people who've had contrast issues. So if this looks good to you or you're happy keeping with the light, let me know. If you want to revert back to the dark, let me know. Okay, so institutional mitigation, right? What is it? Why are we looking for it? Okay, so in the Forex market, there is big banks, big institutions that are trading with large sums of money. Okay, they have liquidity issues, okay? So what I mean by liquidity issues is where they've got large sums of money, they need to manipulate the market in order to get into their positions. Okay, so let's say that the market's moving up, right? The market's moving up and the banks, institutions, whoever is trading the currency at this time, okay, which is going to be multiple people, right? But again, let's try not to get too caught up on why, right? They want to sell out of their position, okay? Hypothetically speaking, let's say they want to sell out of some of their position, right? Where they have got so much money, if they was just to sell at this point all of their position, they'd move the market very fast, and they would get filled at a lot of different price levels. Now, the reason for this is because they would take all the liquidity from the price point, okay? So let's just say here, right, let's say the price is at 152.50, right? There's only going to be so many people at this price point that want to exchange the currency at that time for that price point, for this price. So once they dry up all the liquidity from that price point, the price will then move to the next price point, and once they dry up all of the liquidity from that price point, the price just moves down. Okay, now obviously they are trading this too, right? They don't want to just, you know, start their position here, you know, make profits on their position, and then when they go to take profits, give all the profits back, okay, by being filled in bad places. So how they get out of this is they scale out of their positions, okay? So they won't just sell all at once, right? If you look here, right, this is institutions selling out of their positions gradually. So as you can see here, right, let's say that they started positions here, right, and they did, okay? You get a sell into this liquidity, right, put a break above the structure, and then the position starts. When they want to exit out of their positions, they don't just sell how we do all of their position here, okay? They'll be selling, okay? Probably run some liquidity, buy into some more liquidity so they can sell, right? And they'll be manipulating the price, okay? Now this isn't very, unless you're sort of well versed in the Forex market, it's quite hard to see on this time frame, but if we was to drop down to a 5 minute, you can see this accumulation take place, right? Okay, so this is, again, like I say, this is them buying into their positions, right? The market moves up, and then they are distributing out of their positions, right? And it's just a cycle, okay? And then the same thing is going to happen on the reverse side, right? All right, so now we understand that banks can't just buy and sell like we can, okay, as retail traders. So this brings us on to why we can use mitigation levels. So what is mitigation? Right, by definition, mitigation is just means to reduce the severity of something. Okay, and in this case, the severity is going to be their positions. Okay, so what do I mean by this? Right, if we take this as an example, so let's just remove this. Right. The market is moving down, okay? Again, let's not overcomplicate this, right? Right, the market is moving down, okay? We are in a downtrend. There's going to be, once people start seeing resistance here, right? So let's just take this back, okay? Let's take this back. We can see that we're in a downtrend, right? The market's moving down. We find some resistance, okay? There's going to be plenty of traders that start to look at this and start trying to take this market long, okay? You know, wherever their stops and targets may be. Most likely, you know, looking for, even if it's just a brief pullback into this resistance level, okay? So what does this mean? Right, this means that there's plenty of buying coming into the market, right? And most traders are going to be trading with a stop loss, okay? So they're going to have stop losses below this level. Why? So that they can limit their risk. But what does that mean for us, right? What does that mean in terms of the overall market structure and where the market wants to go? This means that there is liquidity under this level, right? So what I mean by liquidity, you want to look at liquidity in terms of money. Where is the money lying in the market, right? We have got loads of stop losses below this level. Okay, we've also most likely got sell stops below this level. So people that are looking at this downtrend, anticipating it to be a pullback and then continue lower, they want to trade the breakout. So they'll most likely have limit orders, okay, below this level as well. So if the market breaks below this level, they'll get triggered into sell positions, okay, and obviously anticipating the market to go lower, right? So again, most likely sell positions below this level, stop losses up there somewhere maybe, okay, looking for lower prices, right? So ultimately we've got a lot of liquidity below this level, right? Right, so now we understand the main market sentiment, right? What most people are, how most people are viewing this market, right? We've just broken some lows, we're pushing down, we've found some resistance, right? We understand that there's plenty of liquidity below this level. All right, so how can we use this information to trade off of? So let's now imagine that we're a big bank, right? And we've got a lot of money, okay? And like us, remember what I said in this video, and we want to buy this market, right? We want to take up a long position in the market, okay? So if we was just to buy here with the rest of the market, right? Obviously, where we've got such a large amount of capital, we would literally just, you know, we'd move the price and be getting filled at a lot of different price points, okay? So our average buy-in would probably start being around here, okay, as opposed to down here. Even though, you know, we've started buying in here, we'd move the market so significantly that we'd be getting in a bad position. And obviously, if we was to look at how much liquidity is actually in the market, right, we'd soak up all of this liquidity very, very fast. Okay, so we'd probably get quite a lot of our position filled through here, but as soon as we get into areas of imbalance, right, or low volume, we'd plow through them orders, right, and then start getting filled again up at this level, and that is no good if we've got large sums of money. Okay, so we need to, if we're trading with a large sum of money, okay, hypothetically speaking, we need to buy where there's a lot of liquidity, right? Where there is a lot of sell orders, so that when we take up our buy positions, we're not just going to take all the liquidity straight away from the market. So where is all the sell positions? Well, we've already identified they're down here. So what mitigation is it is a selling movement or a buying movement, depending on which way we're looking at it. We'll look at the opposite side in a minute, right? But it's a sell, okay? So it's institutions selling into the liquidity. So sell into the liquidity, right? To then buy in liquidity. So this is the first thing we're looking for, right? We're looking for a sell into the liquidity, so then we can buy out through the liquidity. Okay, so we can accumulate our position down here, right? That's the first step. Now, where does the mitigation come from? Again, like I said, mitigation means to reduce the severity of something, right? So in this case, the banks have sold into the liquidity. Let's pretend this is their P&L sheet, right? This is their balance sheet. They have got negative sales, right? Because they sold into liquidity. So let's just keep it simple, right? Let's just say minus 1,000, right? So they sell 1,000 shares, dollars, you know, whatever it is, right? But once they're in this liquidity, there's a lot more liquidity down here, so they can buy a lot more than 1,000, let's just call it shares, right? They can buy, I don't know, 5,000, say, right? So because of the change in liquidity, they can then accumulate a position of 5,000, right? And again, due to supply and demand, the market starts to rise, okay? So by the time that the banks are up here, right, they have got heavily positive buyers because they obviously was able to accumulate their position and now they're in profit. But they're also hanging on to these sells, okay? They sold the market here in order to accumulate these buyers, and these sells are now negative. So they need to mitigate out of these sell positions. So how do they do that? Well, they start taking profits, out of their buy positions. Okay, so again, they will manipulate the market in order to get out of their buy positions. Okay, and again, I'm not going to get into too much detail around that. I've done a lot of videos surrounding Wyckoff accumulation and distribution. Okay, but they'll distribute out of their sell positions or their buy positions, right? So they have now banked whatever that is. Okay, let's just call it 5,000, right? They've now still need to mitigate this risk, okay, or this loss, okay. So as they start taking their profits, right, and the market starts to lose some steam, they might even help persuade the market down by selling down again, right, which they will then come back to mitigate. And as the market again starts to revert back down, they can then start to buy back their sell positions, okay. So this is obviously where they started to sell into the position, right? So this is where we want to look for some sort of reaction off of this level, which is the mitigation, right? Which is then buying back the negative sells. Okay, so then they're just left with the positive buyers, right? To mitigate their risk. They want to mitigate their risk or mitigate their position in this zone. Okay, so that is mitigation, right? So just a more simplified version. Okay, this is effectively what we're looking for, right? We're looking for some type of trending move or a consolidating move right? We are then looking for a run of the liquidity, a sell-off, and then a retest of that mitigation zone. Okay, so the mitigation zone, right, is the sell down into the liquidity and then the buy. Okay, this is the area that we need to mitigate. Okay, because obviously we've got negative sells. Okay, so then what we're going to look for when we come back into this area is evidence that banks, institutions are mitigating out of their positions and then looking for a move lower. Okay, you can see that we've got liquidity being generated through here. We've got a lot as the market starts to move up, right? So we've got resistance here. As the market starts to move up, this is encouraging more and more people to start buying this market and put their stop losses below here, right? We pull back, we find some more resistance. Again, people are going to be like, right, this market's going to hold. Okay, so they buy, they put their stop losses below, right? And as we come up to this level, again, exactly the same things happened here, right? There's a mitigation level here. We get banks that sell into the liquidity in order to, and again, if we was to drop down onto a lower time frame, in order to accumulate their positions, right, to then take the market higher. And obviously they need to then mitigate out of these negative sells, right, which commenced here, and then they're just left with their positive buys, right? So again, a break above, right, tap down into this order block or the mitigation block, right, mitigation level, to mitigate the risk. Okay, and again, exactly the same thing happens, right? Liquidity generation, sweep of that liquidity, a sell down into the liquidity, right? And then higher prices, okay? And again, exactly the same thing happens, liquidity generation, a push above, a tap down into the mitigation level, and then higher prices, right? And if we was to look at this area here, right, on a lower time frame, it would look like this whole area here, okay, because the market is fractal, right? And again, I don't want to make this video too complicated. Sometimes I can just keep running with this stuff because it is quite an in-depth topic. But if you want to understand more about the fractal nature of the market, check out the video that's linked here. Alright, so I didn't want to make the video too complicated, but I just, you know, went off on a little bit of a tangent. Okay, so let me try and show you some examples, and it should help clear up any confusion. Okay, so, right, look. Level of structure, a run of the liquidity. Okay, this candle here runs the liquidity. Right, we then get a push back down, a move back into the mitigation block. Right, so that is what we're going to define as the mitigation block, right? The candle that runs the liquidity. Okay, so obviously you can see we had liquidity generation here. This candle runs the liquidity, so that is the area we're going to want to pay attention to, okay? And as you can see, look, tap back into that level and then lower prices, right? So let's take a look at some more examples, okay? Alright, so let's just take a look at a few more. I just want to just sort of bring them to your attention so you know what to look for, okay, without any sort of explanation, okay? So you can see liquidity being generated. Find some resistance, start to sell through the liquidity. Okay, start to sell through the liquidity. That is our mitigation level. Break above structural highs, right? Push back down into this zone. Okay, higher prices, right? Liquidity generation. Okay, push down back into the order block, right? Or the mitigation block, mitigation level, mitigation zone, right? Whatever you identify it as. And then a sell-off, okay? Very similar thing here, right? Liquidity generation. Buy up into the liquidity, okay? Buy up into the liquidity, right? Mitigation, mitigation, right? Lower prices, okay? Mitigation, mitigation, lower prices, right? Exactly the same thing on the downside. Liquidity generation, sell down into the liquidity, mitigation, higher prices. Liquidity generation, run of the liquidity, same thing, liquidity generation, right? Tap down. This isn't the best to see. Obviously, if we was to drop down to the lower time frame, it'd be easier to see. And then higher prices, right? Liquidity generation, sell down, mitigation, higher prices. Okay, exactly the same thing. Liquidity generation, a run of the liquidity, mitigation, lower prices, right? Obviously you'd need to drop down to a lower time frame to get this entry. Liquidity generation, sell down into the liquidity, some slight mitigation. Okay, so this may be a point of interest for us. If price can revert down here, we may be looking at these levels to potentially have some sort of relief off of. The only thing I would say is, looking back, that may have just been some mitigation off of this level. Okay, so look, liquidity generation, sell down. Okay, and then the mitigation from that zone. Okay. Yeah, so a nice spike in volume. If you look at the volume, as we spike down, right, a lot of institutional or big banks interest buying down into the liquidity, a run up, and then mitigation. Okay, so I hope that makes sense. Obviously, like I said, I didn't want to make it as complicated as I ended up making it at the beginning of the video, but I hope, like I said, I hope it makes sense. I hope it does help. If it doesn't, then just reach out to me. If it does, then great. Start testing it, start using it in your trading, and I look forward to seeing the results from that. So Wherever you are on your trading journey, I hope you have a good week, and I'll see you on the next one.